2022 is ending soon. My goodness, what a year it's been. We've been just talking about property off air, and don't forget industrial and commercial housing market property has also had a blockbuster session. What lies ahead? Anthony Landahl from Equilibria Finance, and of course he's joining us for a big year in review and a year ahead. Gosh, we'll be here for quite some time.
Got your crystal ball tucked under you.
Let's get cracking. Let's face it, this time last year, house prices were meant to fall double digit. Here we are up double digit. Where did the economists go wrong?
Yeah, well, forecasts are fraught with danger, as we all know. But yeah, you're right. I think about this time last year, or maybe a little bit earlier, they were forecasting about a 14 or 15% drop in the market, and we're sitting here today with the reports that's around about 21.9% growth, which is quite an extraordinary turnaround, and I don't think anyone saw that coming or that on the radar. So yeah, it's been a bit of a roller coaster ride for owner occupiers and investors, but yeah, we are starting to see some moderation of the market and some change.
Yeah, and of course, a big driver of that has been those record low interest rates. Money is cheap. That's got a lot of people into the market. But now, of course, we're looking forward to 2022. Yeah. Rates on the rise. Certainly the key cash rates, but even the retail banks now lifting. I think we had another announcement today from CBA.
Yeah.
What does that mean for both owner occupiers, those trying to get into the market, the first home buyers, and also obviously the investors?
Yeah, you're right, Andrew. The surge was on the back of low rates, cashed up buyers, as well as a demand and supply imbalance. Stock was pretty slow to come on the market, but we are seeing a balancing of the market with rate increases. CBA's had 4 fixed rate increases in about the last month, which is quite unheard of in recent times. We're seeing more stock on the market, and we're also seeing affordability issues and access to credit issues with the regulator stepping in. So we are seeing a moderation of sorts, but in saying that, we're still looking at maybe a 6 to 8% rate of growth over the next 12 months. What we are seeing is investors coming back into the market. They were very much sitting on the sidelines. They were quite wary, but the market has stabilised, and the investment opportunities are now presenting themselves with the borders looking to open up, with some regional areas. So the investors are very much alive and back in the market. I think the owner-occupiers are probably the main ones facing those affordability constraints.
Is that how it sort of usually works that way, particularly when we had a lot of fiscal policies thrown at the first homeowners? So they reached a record share of finance to start with. Owner-occupiers and now investors, like that investor finance has really picked up in recent months. Does that signal the top when the investors are the last to come in?
Yeah, it depends on the market. A lot of investor behaviour was driven by the drop in rent and a lot of uncertainty. Investors changed their strategy. They looked at utilising equity. So they've been focusing on essentially building equity to wait for the next opportunities. So yeah, the investors have let the owner-occupiers ride that wave in growth, and now they're coming in as the market's moderating, and there's also some rental yields now starting to grow, particularly in those regional areas.
Yeah, I was just going to ask you about yields then. Obviously, that's what investors are looking for. So regional areas, why is that, and how are you seeing the inner city unit market at the moment?
Yeah, it's essentially a shift in demand, shift in behaviour. The sort of places people want to live in is changing. Businesses are operating in regional areas. People are looking for areas with a home office, so that's tending to bring an increase in rent due to, again, supply and demand issues. Interestingly, yeah, there was probably an oversupply on the other side of the coin on inner city rentals, and that's where the market really suffered. That's starting to come back a little bit with borders opening, university students starting to come back into play, but that's probably been lagging. However, that is recovering.
Do you see a structural change? Perhaps it hasn't got going yet, but just as far as obviously we're talking about office space, whether it's going to remain utilised, because there is obviously that hybrid model underway, whether that could be converted into residential?
Yeah, the commercial space and the office space is interesting. Just on the commercial market for a minute while we're there, it's been a split market. The logistics and warehousing is booming. Rents are up, prices are up, but interestingly, office space, the values have held whilst rentals have dropped, which is a good sign. But there is conversion in the office space. We're seeing offices either being looked at from a residential perspective, but we've got to bear in mind we've also had the issue of an oversupply in the city, but we're actually seeing offices more being built now as location places for their staff. Smaller areas make it more attractive to the team. So I think we're seeing more of a shift, Andrew, in what the space looks like as much as is it a structural change into residential. We don't have that demand for the residential stuff in the cities again yet, but we are seeing a change in what office space looks like for the tenants.
We were literally having that discussion yesterday because there's such a shortage of potential employees that you have to win people over. So if you have a wellness room and a yoga room and a gym and a great coffee shop or something, so people have to reimagine what coming to the office looks like. So does that mean the actual owners need to step up in terms of what they're offering?
Yeah, and that's happening. We're now seeing more staff coming back into the cities, but we're seeing a lot of that office space that was empty, where rental yields were impacted, being converted into more location premises for their staff.
And talk us through loan approvals, where that's going at the moment, because obviously with those changes that APRA put in place, in fact, they're probably starting to roll over now that 90-day approval period is pretty much expired now.
Yeah, that's pretty much gone. So, as you said, APRA increased the buffer rate, interest rates are increasing, so access to credit is getting more difficult for owner-occupiers and for highly geared investors particularly are suffering from access to credit because there's also some other ratios around debt to income that they're hitting. But it's around about a 5% impact on borrowing capacity. That on top of increases in rates is impacting access to credit.